All right, let's get into the US market analysis for Friday, April 10th. This past week, it really felt like the market was just holding its breath. It was caught between some pretty major geopolitical tensions and, honestly, some very surprising economic data. So we're going to break down what happened and what it all means for the week ahead.
Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
This video presents a direct informational narration of the source document.
Okay, here's our game plan. We'll start with a big picture market overview and see where the money is moving. Then we'll zero in on the critical US-Iran negotiations. After that, it's all about the macro picture, this weird tug of war between inflation and confidence. We'll do a deep dive into the software and semiconductor sectors. And we'll also clear up what's really going on with that JPM 6865 strategy. Finally, we'll wrap it all up with the outlook and risks for next week.
First, our important notice. This document is just for informational and research purposes and is not investment advice. Investing involves significant risk, so with that said, the market really ended the week in a holding pattern. And you have to ask why. Well, it comes down to two big things: those high-stakes geopolitical talks and some pretty confusing economic numbers. The main tension is really shifting now. It's not just about inflation anymore. It's a new tug of war between global risks and the massive spending pouring into the AI industry.
So let's kick things off with the market overview. We saw lower volume consolidation and some interesting sector rotation. Friday was just quiet. Trading volume was way down and prices didn't really move much. But this wasn't just a slow day. It really felt like the big institutional investors were deliberately sitting on the sidelines, just waiting to see how those US-Iran talks would play out over the weekend.
Looking at where the money was moving, the leading sectors were materials, technology, and consumer discretionary. On the flip side, the sectors that were lagging behind were consumer staples, healthcare, and financials. This pretty clearly tells us that investors were moving away from those typical defensive, quote-unquote, safe stocks, likely because of interest rate concerns. And in the background of all this, the US dollar index actually declined for a fifth straight day. Now, normally a weaker dollar helps riskier assets, but it just wasn't enough to calm those geopolitical jitters. Now let's turn to our geopolitical focus, US-Iran. The story here is all about shadow cabinet diplomacy and maximum pressure bargaining. And honestly, this is the biggest story of the week. The negotiations happening in Pakistan are a huge deal. They could not only de-escalate a regional conflict, but they could also have a massive impact on global energy prices.
So there are a few things that make these talks so fascinating. First, this high-level special envoy delegation signals that this is some substantive diplomacy. You have Vice President Vance there, along with Special Envoys Witkoff and Kushner. That is not your typical diplomatic team. By sending these specific high-level figures, who kind of operate outside the usual channels, the US is signaling that it is very serious about getting a deal done. The second point is the maximum pressure rhetoric being used to force these negotiations. And here's a quote from Donald Trump in the New York Times that makes the stakes perfectly clear. If negotiations fail, US warships have been reloaded with the finest ammunition and are prepared to resume strikes. That is the definition of a maximum pressure tactic. But here's the twist. Despite those incredibly strong words, what's actually happening on the water? Well, real-time shipping data shows that passage through the Strait of Hormuz remains completely orderly. So this suggests that while the talk is tough, the vital oil supply line hasn't been cut off, which is giving the market some hope for a positive outcome. Okay, shifting over to the macro picture, inflation versus confidence. And we're really looking at what's being called the confidence shock. What we're seeing is a real battle between two powerful forces. On one side, you have rising inflation, mostly driven by energy prices. And on the other, you have a really sharp drop in how confident people are feeling about their financial future. So let's unpack the latest inflation numbers. The main headline CPI, month over month, jumped 0.9%, which was right in line with the consensus. Year over year, that's 3.3%. Now that big monthly jump was mostly from higher gas prices. But, and this is the key, if you look at core CPI, which strips out food and energy, the picture is much calmer. It was up just 0.2% for the month and 2.6% year over year. This tells us the underlying inflation pressure in the economy seems to be staying under control, for now. But here's that confidence shock. While inflation was ticking up, consumer sentiment absolutely plummeted, from 53.3 all the way down to 47.6. And you can see why. People's expectations for inflation over just the next year jumped significantly, from 3.8% up to 4.8%. However,
And this is a crucial detail, their outlook for inflation over the next 5 years barely budged. This means that while people are worried about the short term, they still believe the Federal Reserve has things under control in the long run. And that gives the Fed some valuable breathing room to act without panicking.
Now for a deep dive into the software sector, where we're seeing a bit of an AI narrative failure and this idea of budget crowding out. The whole story has just completely flipped. For a while, the thinking was that software companies would be huge winners in the AI boom. But now, the fear is that they might actually be a casualty of it.
And we can see this debate playing out perfectly if we look at ServiceNow. On one hand, you have a downgrade from UBS. Their argument is that companies are spending so much money on expensive AI hardware, like NVIDIA chips, that it's creating a zero-sum IT budget environment. That's crowding out traditional software spending. It's robbing Peter to pay Paul. But on the other hand, BNP Paribas has a more constructive view. They're pointing out that ServiceNow's own AI products are bringing in over $600 million in annual contract value. For now, though, it seems Wall Street is siding with that more pessimistic view from UBS. If we look at the charts, the mean software ETF, IGV, has decisively broken below its February low, which is a bearish sign. Not all software stocks are getting hit equally, though. We are seeing some dispersion, with companies like APP and Oracle showing some relative resilience. For ServiceNow specifically, the key support range everyone is watching is between 82 and 92.
So while money is pouring out of software, where's it going? Well, it appears to be flooding into our next topic, the semiconductor sector. Right now, this is all about consensus capital flows and the battle to defend the trend. Chips are really seen as the one sure bet in the market. The market psychology driving this is a deep consensus around the AI compute first framework. The belief is simple. Before you can have amazing AI software, you need incredibly powerful chips to run it on. So for traders, there are two key support levels to watch. The first is an intermediate one, in the 350 to 368 range. But the real trend red line, the strong support zone, is between 336 and 345. As long as prices stay above that zone, the bullish story for semiconductors is still very much intact. Next, let's clear up a common misunderstanding about JP Morgan's 6865 strategy. It's important to understand its gamma anchor nature because what it actually means is often misinterpreted. So, the term is the JPM 6865 level. Here's what you need to know. It is not a market peak forecast. It is not JP Morgan calling the top of the market. Instead, it's the fixed operating strategy code of a specific, very large JP Morgan fund, somewhere around $20 to $30 billion. That level serves as a gamma-heavy zone for their volatility control. Think of it as a preset automated risk management tool for them, not a forecast for the entire market. So what's the outlook for next week? Well, it really boils down to two things interacting, what are called CTA dynamics, and this asymmetric geopolitical trade-off. You've got automated buying from large trend-following funds on one side, and of course, the outcome of those US-Iran talks on the other. This setup leads to two key strategic conclusions. First, there's a warning of a liquidity trap. You have passive automated buying from these funds set to come into the market. But if those Iran talks go badly, that buying could run headfirst into very active, very motivated selling from real people. Those automated buyers could just end up providing an easy exit for sellers, which could get messy. The second risk is that the crowded positioning in semiconductors faces a severe gap down risk if we get bad news from the negotiations over the weekend. And here are the closing remarks. The market is in an extreme dispersion phase. Patience remains important, with the first trading day of next week serving as the initial confirmation point for liquidity. And finally, the professional risk disclosure. This document is for informational purposes and does not constitute investment, financial, or trading advice. Investing involves substantial risk.